We're seeing more bullish behavior out of those Bitcoin whales, as we call them. That's the term for an investor holding more than 1,000 Bitcoin, or at least 1,000 Bitcoin. That's just under $50 million worth at this week's prices.
Yeah, I think that the market has some real positive momentum going forward. Loads of liquidity in the market. You have savings levels at all-time highs.
We really do believe that we're setting up for growth and particularly for innovation to take off again. Now, why are we saying this? Well, innovation solves problems. And we saw what happened in the coronavirus crisis. Innovation took off, and we've talked a lot about it. And we've moved into much more of a digital world much faster than otherwise would have been the case. Well, what are the problems now? Well, price increases are a problem, and consumers don't like them. So innovation does solve problems. I mentioned the electric vehicles. They're coming down in price, and they're better performing cars. They're better for the environment and so forth. So we believe the price decline associated with EVs is going to help solve the auto pricing problem. Cryptocurrencies have taken off as inflation fears have flamed. Crypto is a better hedge. Bitcoin in particular is a better hedge against inflation, if that's the fear, than gold. Gold supplies will continue to increase over time as Bitcoin's supply starts to diminish in terms of the rate of increase. We're also seeing DeFi in the Ethereum world solve problems. The problem that other people have is they can't find enough yield in cash and bonds and so forth. And so the DeFi space is providing 3 to 4% yields where no other place is. Now, you might say that's not a very safe place, but I think a lot of young people are flocking to it. Probably one of the biggest surprises we think that is brewing in the next 3 to 5 years, but we're beginning to see incredible progress now in terms of cost declines, is in healthcare. DNA sequencing costs are plummeting, and innovation is pushing them faster. And I think the other thing that's happening is artificial intelligence training costs are dropping, according to William Summerlin, our analyst, 68% per year. So if the cost of something very important like AI, which is going to go everywhere, is dropping 68% a year, we're going to get more of it. And the world's going to change that much more quickly. He and Simon Barnett, Ali Ehrman, and Pierce on our genomics team are doing a lot of work together on how this is going to drive down molecular diagnostic testing costs, and especially when it comes to cancer screening and so forth. So we're going to solve a huge number of problems as costs are coming down. And even more important in healthcare, we are able, finally, thanks to the convergence of DNA sequencing, artificial intelligence, and gene editing and other gene therapies, we are able to identify mutations, which are the earliest manifestation of disease, in the 3 billion letters, or 6 billion if you consider the base pairs, in each of our genomic profiles. Commodity markets, what are they suggesting? Well, the CRB, the Commodity Research Bureau Index, so it's a broad-based index, but heavily weighted to energy, is starting to tip over. Lumber prices, since the last time I did this video, are down even more. They peaked at 1711 on whatever the metric is, they're down to roughly $500. They got as low as 426, I believe, recently. Copper prices are down from 490. I think we're at 440 now. We're also seeing some early signs, even in the chip space, that there might be some excesses developing there. So Frank Downing, one of our fintech analysts, he's an Ether miner. He watches NVIDIA's RTX 3070 chip. It's a gaming chip very closely in terms of pricing to gauge what's going on in both the gaming world, but also the world of Ethereum. And he mentioned that prices there peaked out at $1,421 in May. They dropped to $1,065 in July. They popped in August in tandem with crypto prices, so but are still below that peak. And the manufacturer suggested retail price for that chip is $500. So still elevated there, but a change in a price signal. On the fiscal policy front, well, the $3.5 trillion package is being debated in the House. And I think we got a signal from Senator Manchin of West Virginia this week that and he has a very important vote in the Senate, he thinks $3.5 trillion is just ridiculous, given that debt to GDP ratio, government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75-80% range. So 100% is quite the marker. And he's also concerned about inflation and that a fiscal package of that magnitude might aggravate some of the inflation indicators that have been flashing red recently. I think that's a very good thing. If he is not for this package, it's not going to pass. I think he's much more for the $500 to $1 trillion pure infrastructure package. We'll see what happens. We do know that this $3.5 trillion is filled with tax increases. Tax increases, I would say, on the biggest job creators out there. That's problematic for those who are worried about the employment situation. It also it includes another tax that I actually thought we'd see much sooner than now, the carbon tax, or a number of different carbon taxes. And we may end up seeing a tax like that. It is a very broad-based tax. It's very regressive, so we'd have to put in place some credits for lower income individuals. But for those who are concerned about the environment, this might be an acceptable tax to pay for perhaps the infrastructure program that hopefully goes through. I think with midterm elections on the way, I mean, the campaign season in some states has already started and will intensify. I'd be shocked if we'd get many lawmakers pounding the table saying we have to have these tax increases. So we'll see. Nancy Pelosi wants the $3.5 trillion before we get to the real infrastructure bill. And this is a setup for a bit of a boxing match, I would say. Today, we got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that because leisure and hospitality employment was flat. And those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues there. So we've got Delta, we've got supply chain issues.